Hi there. Corporation tax return mistakes can lead to HMRC queries, delays, or penalties. In this video, a PTA advisor explains a simple checklist UK businesses can use before filing.
Picture this. You've just filed your company's corporation tax return. You breathe a sigh of relief. Job done. But then, an email from HMRC drops into your inbox. It's a rejection notice. That's an instant 100 penalty right there, and a massive administrative headache to sort out. You've just stumbled into a system that catches even the smallest of errors, and trust me, you are not alone. Seeing this message is an all too common problem for UK businesses. It instantly turns a routine compliance task into a real issue, triggering penalties, a ton of rework, and, of course, unwanted scrutiny from HMRC. So why on earth does this happen so often?
Well, it really comes down to this number. A staggering 15% of the UK's entire tax gap, we're talking about £7 billion, is because of simple, honest errors. This isn't about fraud or deliberate evasion. It's about genuine mistakes made during filing. And this is where most of those frustrating rejections are born. To help us navigate this minefield, we're drawing on the expertise of Pro Tax Accountant. They're specialists in UK tax compliance, and they've helped countless businesses just like yours avoid the common pitfalls we're about to dive into.
Okay, let's get into it. Here's our game plan. First, we'll get our heads around the sheer scale of the problem. Then, we'll break down the most common and easily avoidable errors, and we'll finish up with a really practical checklist to help you get it right first time.
Right, that 15%, it isn't just a number on a spreadsheet. It actually represents thousands of businesses, from brand new startups to established SMEs, all facing unnecessary penalties, cash flow problems, and the stress of an HMRC investigation, all because of avoidable mistakes. And if you look at this official data from HMRC, it tells a really interesting story. Failure to take reasonable care and simple error together account for 46% of the tax gap. That's way more than deliberate evasion. It just goes to show that most businesses are genuinely trying to do the right thing, but they're getting caught out by the system's complexity. So, where do these rejections even begin? Well, you might be surprised. It's often with the most basic information. Simple admin mistakes, like getting a reference number wrong or messing up the dates, are the #1 cause of instant automated rejections.
And here is one of the classic pitfalls: mixing up your UTR and your CRN. Your UTR is that private 10-digit tax ID for HMRC. Your CRN, on the other hand, is your public 8-digit ID for Companies House. Using your CRN on a tax return is literally like using your postcode instead of your house number. The system just can't find you, and it causes an immediate authentication failure.
Here's another trap that catches so many people out, especially startups. Let's say your first accounting period is 15 months long. Now, Companies House is perfectly happy to accept one set of accounts for that entire period. But, and this is the crucial bit, for corporation tax, a single CT600 return can't cover more than 12 months. That means you have to file 2 separate tax returns. If you just file one for the full 15 months, it's a guaranteed rejection. So you've passed the identity check. You're not out of the woods yet. Your return now faces its next hurdle: HMRC's automated maths checks. This is where the system makes sure all the figures in your return actually make sense and add up correctly. If they don't, you fail what's known as a business logic test. And that failure has a name: Error 3001. It's a bit of a catch-all code from MRC's system when your return fails its internal checks. Essentially, the computer is just saying, hang on, these numbers don't add up. It's not an accusation of anything dodgy, it's just a clear signal that the data you've submitted is flawed.
You have to remember, these checks are completely automatic and they're instant. For example, if your company had 0 turnover, you must enter a 0 in box 145. If you leave it blank, instant rejection. If the total profit figure in box 315 doesn't exactly equal the sum of all its parts, rejected. Any little discrepancy will trigger that dreaded Error 3001.
And it's so important to stress that these are not just issues for massive corporations. They frequently hit SMEs, startups, and contractors, businesses that might not have a dedicated accounts department. The sheer complexity of UK tax law, combined with limited resources, creates a perfect storm for these kinds of errors.
So, it's not enough for your numbers to be correct. They also have to be submitted in a very specific digital language that HMRC systems can actually read. This is the final automated hurdle that your return absolutely has to clear.
and that language is called IXBRL. The best way to think of it is like a digital tag on every single financial figure in your accounts. HMRC's computers don't read the document like you or I would, they just read these tags. A really common reason for failure here is using an outdated set of tags, which is called a taxonomy. It's basically like trying to speak to the system using an old dictionary that's missing all the new words. So to quickly recap this digital gauntlet, your return has to pass all 3 of these automated gates, one after the other. First, it authenticates your identity. Second, it checks the business logic of your figures. And third, it validates the technical IXBRL format. A failure at any one of these stages means your submission is kicked back out and it's back to square one. Okay, now let's zoom in on 2 high-risk areas that need extra forms and absolute precision: R&D claims and director's loans. Get these wrong, and it's a huge red flag for HMRC. Now, this process is completely non-negotiable. To claim R&D tax relief, you must, and I can't stress this enough, submit the additional information form to HMRC before you file your main CT600. Filing the CT600 first, even if it's on the same day, will get your entire R&D claim automatically rejected. The order of operations here is everything. And what about director's loans? Well, if a director owes the company money and that loan isn't repaid within 9 months and 1 day of the company's year end, the company has to pay something called Section 455 tax on the outstanding amount at this very hefty rate. This has to be calculated and reported perfectly on a supplementary form called the CT600A. Getting this wrong can lead to some really costly errors and nasty interest charges.
Right, we've covered a lot of problems, so let's turn to the solution with an actionable checklist. This is what will help you join the 85% of businesses who get it right the first time, making the whole process smooth and, frankly, a lot less stressful.
First things first, the admin basics. Grab an official letter from HMRC and physically double-check your 10-digit UTR. Make sure the accounting period dates on your return exactly match the notice to deliver they sent you. Always remember the 12-month rule. And here's a pro tip. Do a final scan to make sure no mandatory boxes have been left blank. That simple check prevents the easiest, most common rejections.
Okay, next up are the technical and supplementary checks. Make sure your accounting software is up to date with the latest IXBRL taxonomy. For any R&D claims, confirm that the AIF was definitely filed first. For director's loans, triple-check the CT600A form and the tax calculation. And finally, do one last big review to ensure all the numbers in the tax return line up with your statutory accounts.
You see, filing your corporation tax return really shouldn't feel like a game of chance. By transforming it into a controlled, checklist-driven process, you can file with total confidence. It all boils down to precision, process, and sometimes getting a bit of professional guidance. The only question left is your current process robust enough to catch these simple yet potentially very costly errors?
Look, if navigating all these complexities seems a bit daunting, or if you just want the peace of mind that comes from knowing it's been done right, it's always a good idea to seek professional help. The experts at Pro Tax Accountant can manage this entire process for you, ensuring compliance and accuracy. You can reach them on the details you see here, and make sure you subscribe to their channel for more valuable insights like this.
And finally, the necessary legal bit. This content is for informational purposes only, as of the date shown, and it does not constitute professional tax advice. Tax laws are incredibly complex, and your company's situation is unique, so please always consult with a qualified professional for advice that's tailored specifically to you.